Conservative investors want crypto exposure, but don't want to wake up at 3 in the morning checking charts. And honestly, that's the most rational thing you've said all year. The stakes are real. Digital assets crossed a $2 trillion market cap again. Institutional money is flooding in. And yet most cautious allocators are still standing at the door, unsure whether to knock. So why is this even a conversation for conservative portfolios in 2025? Because Bitcoin ETFs now trade on the New York Stock Exchange the same way you'd buy shares of a blue chip company. And that changes everything about access, custody, and legitimacy. The catalyst wasn't hype, it was regulatory clarity finally catching up to a decade of stubbornness from traditional finance. Think of it like this. You don't have to move into the neighborhood to invest in its real estate. Sometimes you just buy a stake in the developer. That's essentially what spot Bitcoin ETFs, crypto-adjacent stocks, and blockchain-focused funds allow you to do without ever touching a digital wallet. Remember when everyone was boldly declaring crypto the future of money back in 2021, then watched portfolios drop 70, 80% within 18 months? The optimism was intoxicating. The headlines were electric. And then the music stopped, and a lot of people learned expensive lessons about position sizing the hard way. The psychological damage from that cycle is still real. Surveys show nearly 40% of retail investors who bought crypto near the 2021 peak still haven't recovered their confidence, let alone their capital. But here's the counterweight. The institutions that quietly accumulated during the crash are now sitting on generational gains, which is either inspiring or infuriating, depending on where you were sitting. Crypto has now gone through at least 3 major boom and bust cycles, and each time the baseline recovery price has been meaningfully higher than the last. That's not a guarantee, but it's a pattern worth respecting. The same way you'd respect a river that keeps flooding, but always finds a new, slightly elevated bank. Here's where it fits in the bigger picture. Crypto, like venture capital or commodities before it, follows an adoption curve, where early volatility eventually compresses as liquidity deepens and institutional frameworks mature. Community analysts on platforms like X and Reddit have been calling for a boring bull market phase, where slow, steady appreciation replaces the manic swings, and for once, their thesis has some structural backing. One big misconception we need to kill right now is that getting crypto exposure means you have to buy coins directly, manage seed phrases, and pray your hardware wallet doesn't get lost in a move. You can get meaningful, regulated, tax-efficient exposure through a brokerage account you already have, using instruments that behave like any other fund. The practical playbook for conservative allocators looks something like this. 1 to 3% of your portfolio in a spot Bitcoin ETF like iShares or Fidelity's offering, maybe a small slice in a diversified crypto index fund. And if you want equity-style exposure, companies like Coinbase or MicroStrategy give you indirect leverage without direct custody risk. The key is disciplined position sizing, not conviction, not timing, not vibes. Process beats prediction every single time in markets. And crypto is no exception. You don't need to believe in the technology to respect the trade. You just need rules and a rebalancing schedule. One good entry strategy is dollar cost averaging, a fixed amount monthly, which removes the emotional weight of trying to call a bottom and historically smooths out volatility over a 3 to 5 year horizon. The irony here is almost poetic. The asset class that was built to overthrow traditional finance is now most safely accessed through the very institutions it was designed to disrupt. Your brokerage, your IRA, your financial advisor, they're all now the on-ramp, which is either the ultimate co-optation story or the ultimate validation story, depending on your philosophical leanings. Discipline, sizing, and consistency are the only 3 words that matter when you're talking about adding any volatile asset to a conservative portfolio, not which coin, not which exchange, not what the chart looks like on a Tuesday afternoon. If your allocation is small enough that a 50% drawdown doesn't materially affect your financial plan, you've sized it correctly. And that's genuinely the whole secret. You don't have to be a crypto believer to participate in its potential upside. You just have to be a rational allocator who respects asymmetry and manages downside with position limits. Whether Bitcoin goes to 500,000 or back to 20,000, a 1 or 2% allocation means you either smile quietly or shrug and rebalance, and both outcomes are perfectly livable. The market doesn't reward the most passionate, the most informed, or the most convicted. It rewards the most consistent, the most patient, and the most ruthlessly unemotional. Whatever exposure you choose, make the decision once, write down your rules, and then let the process work without checking prices every morning like it's a second job. And if you're ready to put that same disciplined, strategic mindset to work in assets you can touch, whether that's real estate investing, home contracting projects, or connecting with the right lenders, check out our links in the description below, and let's build something together.